We can cross live to Washington, D.C., the venue of the 2022 IMF World Bank Group annual meetings, where IMF chief economist Pierre-Olivier Gouchinas and Petia Coeva-Brooks and Daniel Lee present the latest forecast for the global economy.
And also, I want to remind everybody online and here in the room that we have several languages interpretation. Without further ado, Pierre-Olivier, the floor is yours.
Thank you, Jose, and good morning, everyone. The global economy continues to face steep challenges shaped by three powerful forces: the Russian invasion of Ukraine. Despite the slowdown, inflation pressures are proving broader and more persistent than anticipated. Global inflation is now expected to peak at 9.5% in the third quarter of 2022, before decelerating to 4.1% by 2024. Inflation is also broadening beyond food and energy. Global core inflation rose from an annualized monthly rate of 4.2% at the end of 2021 to 6.7% in July for the median country. Downside risks remain elevated, and policy trade-offs have become acutely challenging. Here are a few of the ones we highlight in our report. The risk of monetary, fiscal, or financial policy miscalibration has risen sharply at a time of high uncertainty and growing fragilities. Global financial conditions could deteriorate and the dollar strengthen further should turmoil in financial markets erupt. Inflation could yet again prove more persistent, especially if labor markets remain extremely tight. Finally, the war in Ukraine is still raging, and further escalation can exacerbate the energy crisis. Our October World Economic Outlook report presents a risk assessment around our baseline projections. With 25% probability, global growth next year could slow down to below 2%, a historically low level. We've only had that 5 times since 1970. If many of the risks materialize, global growth would decline to 1.1% with quasi-stagnant income per capita next year. According to our calculations, the likelihood of such an adverse scenario would be around 10 to 15%. Increasing price pressures remains the most immediate threat to current and future prosperity by squeezing real incomes and undermining macroeconomic stability. Central banks are now laser-focused on restoring price stability, and the pace of tightening has accelerated sharply. There are risks of both under and over-tightening. Under-tightening would further entrench the inflation process, erode the credibility of central banks, and de-anchor inflation expectations. As history repeatedly teaches us, this would only increase the eventual cost of bringing inflation under control. Over-tightening risks pushing the global economy into an unnecessarily harsh recession. Financial markets may also struggle to adapt to an overly rapid pace of tightening. Yet the cost of these policy mistakes are not symmetric. The hard-won credibility of central banks would be gravely undermined if they misjudge, yet again, the stubborn persistence of inflation. This would prove much more detrimental to future macroeconomic stability. Where necessary, financial policy should ensure that markets remain stable. However, central banks around the world need to keep a steady hand, with monetary policy firmly focused on taming inflation. Formulating the appropriate fiscal response to the cost of living and energy crisis has also become a serious challenge for many countries. Let me mention a few key principles. First, fiscal policy should not work at cross purpose with monetary authorities' efforts. Doing otherwise will only prolong inflation and could cause serious financial instability, as recent events reminded us. Second, the energy crisis, especially in Europe, is not a transitory shock. The geopolitical realignment of energy supplies in the wake of the war is both broad and permanent. Winter 2022 will be challenging, but winter 2023 will likely be worse. Price signals will be essential to curb energy demand and stimulate supply. Price controls, untargeted subsidies, or export bans are fiscally costly, lead to excess demand, undersupply, misallocation, and rationing. They rarely work. Fiscal policy should instead aim to protect the most vulnerable through targeted and temporary transfers. Third, fiscal policy can help economies adapt to a more volatile environment by investing in productive capacity, human capital, digitalization, green energy, and supply chain diversification. Expanding these can make economies more resilient when the next crisis comes. Unfortunately, these important principles are not always guiding policy right now. The strength of the dollar is also a major challenge. The dollar is now at its strongest since the early 2000s, mostly against advanced economies, but also against emerging markets. So far, this rise appears mostly driven by fundamental forces, such as the tightening of monetary policy in the United States and the energy crisis. The appropriate response is to calibrate monetary policy to maintain price stability while letting the exchange rate adjust, conserving valuable foreign exchange reserves for when financial conditions really worsen. In other words, as the global economy is headed for stormy waters, now is the time for emerging market policymakers to batten down the hatches. Eligible countries with sound policies should urgently consider improving their liquidity buffers, including by requesting access to precautionary instruments from the fund. Countries should also aim to minimize the impact of future financial turmoil through a combination of preemptive macroprudential and capital flow measures where appropriate, in line with our integrated policy framework. Too many low-income countries are close to or already in debt distress. Progress towards orderly debt restructuring through the Group of 20's common framework is urgently needed to avert a wave of sovereign debt crisis. Time may soon run out. Finally, the energy and food crisis, coupled with extreme summer temperatures, starkly remind us of what an uncontrolled climate transition would look like. There are clouds on the horizon, but progress on climate policies, debt resolution, and other targeted global issues will demonstrate that strengthened cooperation can achieve progress for all and help to overcome geoeconomic fragmentation. Thank you.
Those bilaterally. And with that said, I think we're going to start here in the front. We're going to start with Andrea Shalal, Reuters.
Thank you, Andrea Shalal with Reuters. I wanted to follow up on your remarks about the debt crisis. You say that time is running out. I mean, it's been years now since the common framework was set up, and there's only been 3 cases. They haven't been finished yet. What can you do here as an institution to put more emphasis on that and to increase the momentum? And do you see any signs that the private sector, lenders, creditors, and China are willing to move?
Well, I think you're pointing out that there is effectively a serious issue of debt restructuring that is needed for a number of especially low-income countries. The common framework has been put in place, as you pointed out, by the Group of 20 a number of years ago. Only 3 countries have approached the common framework. There's been progress. For a long time, not much was happening, but there's been progress recently, especially in the case of Zambia, and I think we want to point that out. And more progress is needed. The hope is that somehow the progress that can be made with a country like Zambia can also help facilitate the process for other countries in the future. There's no doubt that many countries need to engage in discussions with their creditors, need to approach them, they need to approach the fund to start thinking about how to reduce unsustainable debt levels. And we certainly encourage countries to do that. For the low-income countries, the common framework can help. For others, they can form creditor committees or approach their creditors to form creditor committees and try to make progress on this.
Thank you, Pierre-Olivier. We're going to stick here in the front, and then we will move around the room. Xinhua.
Thank you for taking my question. It's Maolin Zhang with China Xinhua News Agency. I want to ask about the climate transition. the report mentioned that climate policies might have some modest adverse impact on the near-term economic activity and inflation. But if we delay the action, there is going to be more cost. It's going to be catastrophic. And what's your reaction to the argument that right now we're facing multiple challenges, we need to address the crisis immediately, and then maybe we can worry about climate policies later on? Why the urgency? Thank you.
Yes, we have in our World Economic Outlook an entire chapter on the near-term cost of the macroeconomic transition. And an important point here is to emphasize the main message from that chapter, which is that there are some costs of doing the macroeconomic transition, the climate transition on the macroeconomic side. These costs are very, very modest in comparison to the cost of not doing the climate transition, everything that would happen if climate and temperatures increase in an uncontrolled fashion. Now, sometimes we hear, well, we see with the energy crisis, for instance, we see what happens when there is a very high energy price. It's very disruptive for macroeconomic policy. And one of the things that this chapter emphasizes is the climate transition is of a different nature. It's a gradual process, and the gains are much larger if that process is started early. So yes, we have to deal with the energy crisis right now. Yes, a number of countries are facing themselves in a situation where they need to procure more energy to produce electricity over the winter, etc. But the path that we should embark on in terms of the climate transition is something that we cannot ignore as well. And it doesn't require that we do all of the adjustments up front, but that we engage on a credible path towards achieving our 2030 objectives.
Okay, we're gonna stick with the front and then move around. Colby, FT.
Colby Smith with the Financial Times. The report repeatedly mentions the need for central banks to stick with their monetary tightening plans in order to ensure that inflation does not get further out of control. But given that we've already seen significant front-loading and there are lags associated with any kind of monetary policy changes, I'm curious if you think it's time for central banks like the Fed to moderate the pace of rate hikes from this 75 basis point clip and think about something a bit more measured.
Well, what we are recommending is that central banks stay the course. Now, that doesn't mean that they should accelerate compared to what they've been doing, if we think about the Fed, for instance, but it also doesn't mean that they should sort of pause on the path towards monetary normalization that we've seen. Let's step back for a minute. We are not starting from a position where central banks were in neutral when they started increasing rates. We're starting from a position where rates were historically low because countries were coming out of the pandemic. So a lot of what we've seen so far is monetary normalization, central banks coming closer to sort of a neutral stance, which is very appropriate given that the economy is not in the COVID-related recession anymore and that you have disinflation pressures. Now, you're absolutely right that there are lags in the transmission of monetary policy, but we also have a very elevated level of inflation. And when you look at core measures of inflation, they are still pushing upwards. So it's a little bit early to think about moving to something else. I think right now our advice is let's make sure we see a decisive decline in inflation, which, by the way, in our forecast, we're seeing happening, inflation peaking around now or towards the end of the year, depending on the countries, and then in 2023, inflation coming down, conditional on the path for monetary policy that countries have implemented. So this is how I want to explain what we mean when we say stay the course.
Eric Martin, Bloomberg.
Yes, thank you very much. Dr. Goran.
So this is how I want to explain what we mean when we say stay the course.
Eric Martin, Bloomberg.
Yes, thank you very much. Dr. Goran Shah, I wanted to ask you about the downside scenario modeling regarding the global pandemic. And in the last couple of years, the danger of new variants has been one that's been very prominently flagged in the global outlook. It's mentioned in this outlook, but fewer than about a half dozen times. And I was want to ask about, we're all meeting here for the first time since 2019 in person. How confident is the IMF regarding the outlook for the global economy in light of COVID and the possibility of new variants? Last year the vaccination was an issue that was flagged very strongly by the IMF last summer. How does the fund view the distribution of vaccines and just the global public health response? And is the worst, is the worst of the risk behind us? Or are you concerned about, this winter and things like Omicron, other virus issues cropping up?
Well, thank you, Eric. Certainly the risk of further variants or resurgence of the pandemic is something that we mention in our report as one of the downside risk. We haven't included it in our adverse scenario modeling. We've included other risks which we thought were maybe more immediate risks that the global economy was likely to face, but it's certainly one of the risks we highlight. Now, it is the case that as of now, most countries have reopened, and as we can attest today that activities have sort of resumed on a quasi-normal course. There are a few exceptions to that, and of course, obviously, an important exception is China, where a different health policy path has been charted, and as a result, the country is still facing continued localized but important sometimes lockdowns, and that's something that is weighing down on Chinese economic activity in our baseline forecasts because of the continuation of the zero COVID policy.
Larry Elliott, The Guardian.
The Bank of England has been stepping into the bond market in the UK today to prevent disorder and disruption. How much of that is the consequence of the Chancellor's fiscal package on the 23rd of September, which announced unfunded tax cuts and a blanket support for energy users? What are the spillover risks to the global markets? And what advice would you give to the Chancellor when he comes up with another fiscal package at the end of this month?
Well, very important question. We've seen a lot of turbulence in the gilt market of late. Certainly our advice to countries, as I've mentioned in my opening remarks, is that fiscal policy should be aligned with the objectives of monetary policy. And it's a little bit difficult if you think about central banks that are trying to tighten monetary policy, and if you have at the same time fiscal authorities that try to stimulate aggregate demand. It's like having a car with, two people in the front, and each of them has a steering wheel and is trying to steer the car in a different direction. That's not going to work very well. So our advice has always been that fiscal policy should be cognizant of the central bank's efforts and should try to be as close to neutral as possible. Now, what we've seen in the UK market, we've seen market dysfunction related to some illiquidity in some segments, and you may want to attend Tobias Adrian, the financial counselor, press conference for the GFSR later today, where he will also talk about this from the market perspective. And so there's been a need for the Bank of England to come in and address the market dysfunction. Central banks have a financial stability mandate. They need to do that. And so the Bank of England is sort of navigating these dual objectives. On the one hand, continuing on the path towards monetary tightening that is needed to address the inflation pressures, and at the same time addressing pockets of market dysfunction that may be arising. In the particular case of the UK, maybe due to the pension funds and the liability-driven investment. Having said all of this, it's very clear that stability can be improved both in the financial markets and more broadly with a fiscal package that is going to be consistent with what the Bank of England is trying to do. And from that perspective, we certainly welcome the government's announcement of a fiscal event at the end of the month and the involvement of OBR in assessing making the forecasts on those fiscal plans.
I see two virtual hands on WebEx, our friends from GK News and TASS. Please, where you can go first, and then Anton, you can go second. Formulate your questions, we compile them, and our friends here can answer.
Washington, D.C., venue of the 2022 IMF World Bank Group annual meetings, where IMF chief economists are presenting their global outlook.
ways, in terms of just the broad outlook, of course, there are many, many important differences. But in terms of the broad outlook, it's a little bit similar to Italy in the sense that we had also an upward revision, and Spain did very well in 2022 with a growth of 4.3% that we're projecting as of now. Strong tourism. And 2023, the same forces that are weighing down on Italy are also weighing down on Spain. So energy, of course, weak demand, and the tighter monetary policy. All of these, so the combination of these three things is weighing down. Now, in terms of Latin America, what we have in Latin America is a little bit of heterogeneity, but we have a group of a region that has actually fared pretty well also. A number of them had started tightening monetary policy well ahead of advanced economies. So if you think about countries like Brazil or others, they started tightening policy quite early already in 2021. And so they were ahead of the curve a little bit there. And so some of them were also propped up by high energy and commodity prices. And so that buffered them in 2022. But let me turn it to Petja to provide maybe a little bit more granular details.
Sure. So on Spain, indeed, the pattern is the same, similar to other European countries, but the growth rates are significantly higher. So we're talking about 4.3 for this year and 1.2 for 2023. And Spain is a country where the European new generation funds are expected to also boost activity. One caveat here is that the second quarter data was actually released after the cutoff for the forecast was made. So if that forecast were done now for 2023, we would probably see even higher numbers than what we currently have. And when it comes to Latin America, we have upgraded the forecast for this year to 3.5 and downgraded modestly the forecast for 2023 to 1.7. And again, this is a region that's exposed to commodity price developments, to external demand, and to tightening financial conditions, as well as many countries depend on remittances as well as tourism. So it's a little bit of a heterogeneous picture.
Well, thanks for staying with us on Newsday. It's time now for business news. European and Asian shares were mostly down earlier in the day as investors fretted about rising interest rates and the impact of U.S. export restrictions on the world's biggest chip makers. Asia's stock markets followed the U.S. lower, with Hong Kong's benchmark index dropping to its lowest level in nearly 11 years. The Bank of England today announced an expansion of its emergency bond buying operation as it looks to restore order to the country's chaotic bond market and help a struggling pound. And U.S. markets have opened for cash trade. Ahead of the open, in pre-market trade, stock futures were also mostly down. This is as markets digest the IMF's latest update on the world economic outlook. Our Rise business analyst, Bode Ososome, is here to take us through the opening. Bode, thanks for joining us on Newsday. Now help us understand what is moving markets as the New York Stock Exchange opens for cash trade. Are we getting the markets to reflect the mood we just heard from the IMF on the global economy?
Yes, thank you for having me on the show. Indeed, just like the IMF outlook mirrored the pessimism in the 2023 performance particularly, but 2022, it seems the IMF is still holding on to their previous forecast. But looking at what we're seeing on the New York Stock Exchange, S&P 500, when the stock exchange opened just 10 minutes ago, is now down 0.73%. NASDAQ is down 1.02%, and the Dow 30 is also down 0.21%. So you see the stocks really consistently in the red. Remember, the Nasdaq Composite yesterday closed at its lowest in 2 years. And investors apparently, I think they're looking at the inflation data that is going to be out later in the week for the US and the start of the earnings season. But I think this is broadly mirroring the pessimism, especially in the long-term outlook the IMF just told us was that the global economic activity is experiencing a broad, sharper than expected slowdown, with inflation higher than seen in several decades. And the cost of living crisis, the tightening financial conditions, which you see in most regions, Russia's invasion of Ukraine, and even the lingering COVID-19 pandemic slowing down China, these are all weighing heavily on outlook. But what the IMF have done, although they're forecasting a slowdown from 6% in 2021 to 3.2% in 2022, they have not revised downwards the 2022 forecast, although they did revise the 2023 forecast downwards by 0.2%. So it's now going to be 2.7%. But I think broadly what we are seeing is a situation where most countries are going to perhaps be challenged in 2023, even though 2022 could still look fair given the outlook that we're seeing. The other thing that the IMF mentioned, which is important, is that the energy crisis in Europe, the IMF said very clearly, is not a transitory shock. The winter in 2022 is likely to be challenging, but 2023 is likely to be worse. I suspect the IMF is seeing a situation where we're going to see lingering geopolitical issues, which will continue to impact the energy landscape. The other thing that was mentioned, especially in terms of monetary policy and the tightening we see in banks are told to be very careful in terms of the recalibration of monetary policies so that they don't overdo it or get to a situation where they choke growth. At the same time, the warning not to be expanding on the fiscal side while tightening on the monetary side was again re-emphasized. Otherwise, you will get a situation where inflation just lingers for longer. And they're also emphasizing structural reform to support the fight against inflation, to improve productivity and ease some of the supply constraints. They also spoke concerning emerging markets. They need to watch fiscal space and also embrace reform to enhance productivity. That, in a nutshell, I think is what we heard. The details just came out today, so we'll be pouring through the report. But I can see, just as we speak, NASDAQ is down 0.89%, Dow 30 is down 0.06%, S&P 500 is still down 0.62%. So clearly, the sentiment is somewhat bearish, and maybe when the inflation figures come out towards the end of the week, there will be more clarity in terms of how the environment is going to impact equities.